James spent most of his late 20s convinced that dividend investing was the simplest path to financial independence. Buy enough of the right stocks, collect the checks, stop working. The math seemed straightforward. Then he actually ran the math. The numbers that came back were larger than he expected, more conditional than the content he had been watching suggested, and complicated by a tax reality that almost nobody explains clearly up front. This video covers what James eventually learned, how much you actually need invested to live off dividends in 2026, why chasing the highest yield is often the wrong approach, and what the honest trade-offs look like, depending on where you are in your investing life. The calculation itself is simple. Divide your target annual income by your portfolio's dividend yield percentage. The result is the total investment required. If you want $50,000 annually in dividend income and your portfolio yields 4%, divide 50,000 by 0.04. You need $1.25 million invested. If your portfolio yields 3%, divide by 0.03. You need $1.67 million. The yield percentage is the critical variable, and it shapes the required investment amount more than almost anything else. Most real dividend portfolios, built from quality dividend-paying stocks rather than the highest yield names available, generate somewhere between 2.5% and 3.5% annually. At 3%, generating $50,000 in passive dividend income requires approximately $1.67 million invested. At 3.5%, it requires roughly $1.43 million. These are not small numbers, and they are the honest baseline for anyone planning around dividend income. The obvious reaction to these numbers is to find stocks yielding 6 or 8% and cut the required investment in half. This is the instinct that gets dividend investors into trouble, and it is worth understanding directly. Companies that pay very high dividend yields are often in that position not because they are generous, but because their stock price has fallen significantly, which mathematically inflates the yield, or because they are distributing cash at an unsustainable rate relative to their earnings. Both situations are warning signs rather than opportunities. James watched this play out with several well-known dividend stocks over the past few years. Companies that had raised dividends consistently for decades cut them when business conditions shifted. Every dollar distributed as a dividend is a dollar not reinvested in the company's own growth. And when a company's growth slows and competitors advance, the dividend often follows. The yield that looked attractive became a signal of deteriorating fundamentals rather than reliable income. Dividend aristocrats, companies within major indices that have raised dividends consistently for at least 25 consecutive years, tend to cluster in a yield range between 1% and 4%. That is where the quality and the consistency actually live. Reaching significantly above that range usually means accepting meaningfully higher risk that the income continues. Here's the honest trade-off that most dividend investing content avoids discussing directly. Research comparing dedicated dividend portfolios against broad market index funds over multi-decade periods consistently shows that total return, price appreciation plus dividends combined, has historically been somewhat higher for the broad market than for dividend-focused portfolios. Dividend strategies tend to overweight certain sectors like utilities, consumer staples, and healthcare, while underweighting technology and growth-oriented sectors that have driven significant market returns in recent decades. This does not make dividend investing a poor strategy. It makes it a specific strategy with specific trade-offs. For someone approaching retirement who wants predictable income without needing to sell shares, dividends provide a psychologically and practically useful structure. For someone in their 20s or 30s with decades of compounding ahead and no immediate need for income, a growth-focused total market approach has historically produced more wealth by the time the income is actually needed. For investors under approximately 35, the argument for prioritizing broad market index funds over dividend-focused portfolios is strong. The compounding runway is long enough that the higher long-term total returns of the broader market produce meaningfully more capital by retirement, which can then be converted into income through whatever method makes sense at that point, including transitioning toward dividend-paying assets. A $10,000 portfolio yielding 4% generates $400 annually. That is not enough to matter. The same $10,000 growing at historical market rates for 30 years is considerably more useful. For investors in their 40s and 50s, beginning to introduce dividend-paying assets in a growing allocation makes more sense. 5 to 10% allocated to quality dividend ETFs in the 30s, growing toward 15 to 30% in the 40s, and potentially higher as retirement approaches. This gradual transition builds income capacity without sacrificing the growth years when a larger portfolio is still being assembled. For someone already at or near retirement with sufficient capital, a portfolio designed to generate 3 to 4% in dividends annually while maintaining principal is a legitimate and sustainable income strategy, particularly with the tax advantages available. Dividends are not free money. They are taxable income, and understanding how they're taxed affects both the strategy and the actual after-tax income produced. Qualified dividends, which most dividends from U.S. stocks and ETFs held for longer than 60 days become, are taxed at the long-term capital gains rate rather than ordinary income rates. For someone with no other income whose only income is $50,000 in qualified dividends, the federal tax bill may be relatively modest, or potentially zero, depending on filing status and the specific thresholds in effect. However, dividends received in a taxable brokerage account are taxed in the year received, regardless of whether they are reinvested. This creates a tax drag during the accumulation phase that a growth-focused investor without dividend distributions does not experience. Holding dividend-paying investments inside a Roth IRA eliminates this. All growth and all distributions remain permanently tax-free. For someone specifically building toward dividend-based retirement income, a Roth account is the most tax-efficient container available. The honest summary of dividend investing in 2026 looks like this. It is a viable and sustainable strategy for retirement income. It requires more capital than most people initially expect. The quality of the dividend matters considerably more than the size of it, and the right time to emphasize it in a portfolio depends heavily on how far from retirement you currently are. James still holds dividend-paying assets, a growing allocation as he moves through his 40s, but he no longer thinks of dividends as a shortcut. They are one tool among several, most useful when income is actually needed, and most powerful when built from quality companies at reasonable yields, rather than chased from companies offering yields that look attractive for reasons that turn out not to be. The formula is simple. The execution requires patience, realistic expectations, and an honest look at what the numbers actually require, rather than what we wish they required. Divide your target income by your realistic yield. That is your number. Build toward it deliberately.